knowledge of the endowment model. Okay, an important one, guys. Okay, and the endowment model, okay, if memory serves, I don't think we write it over here, guys, came from Yale, the university, of course, in response to just to making sure that they could keep the long life of their endowments going. That's what's called the endowment model, of course, okay, with earning sufficiently high returns. It doesn't help to sit in low return investments because, of course, you can't spend that much because your returns are low. So the endowment model came about in an attempt to try and earn a little bit more on the particular investments, just to make sure that they could increase the lives of their particular endowments and foundations. Okay, we move ahead over here. Okay, let's have a look. Okay, it was developed, of course, I'll read it to you verbatim over here, okay, to meet the high return requirements, okay, that will allow the endowment to last longer. Okay, and the thought that was put forward was that endowments can earn higher returns, and one of the reasons that they can earn higher returns is that they can sit in less liquid investments because they don't need the money straight away, so they can be a little bit less liquid, and because their time horizons generally on an endowment and a foundation are generally going to be a little bit longer. Okay. Okay, let's look what they do invest in, and let's look what this particular model called the endowment model does like and what it doesn't like. It doesn't provide too much investment in corporate bonds, as high risk stuff, foreign fixed income securities. Okay, generally, okay, they say that corporate bonds offer low returns when you look at them relative to treasury bonds. Okay, and their liquidity and value drops significantly in times of crisis. Okay. Same reason similarly for foreign fixed income, as well as, of course, foreign fixed income exposes the investor to foreign exchange and event risk as well. Okay. However, what's interesting is that they do, even though it does offer very low returns, US treasuries, they do like to invest in domestic treasuries in this model, okay, for two reasons. Number one is it provides very good liquidity because you can get in and out very quickly, okay, and it does act as a protector against tail risk because they are very secure investments. Okay. If that were so, and what we said in the beginning, that the endowment model is there to try and meet high return requirements, well, if we're investing in US treasuries with low returns, where is my high return coming from? Okay, they are heavily invested in alternative investments, okay, which over time, okay, and of course subject to debate, generally they've proven to offer better returns than the traditional equities and bonds. Okay. Good. So remember, it's something that we look at. Another interesting point about the endowment model, okay, there is a positive correlation between the size of the endowment, the returns, and the amount that they allocate to alternative investments. In other words, the bigger the endowment, the higher the returns, and the higher the allocation towards alternatives. Conversely, the smaller the endowment, the lower the returns, and the lower the allocation towards asset allocation. Okay, over our page we look at these for some reasons. We'll look at them as to, in terms of this endowment model, well, how does it work? How does it work? Why does it work? What are some of the things over here? Okay, and we look at 6 attributes of the model, and of course I'm going to go through each one of these attributes in greater detail. We talk about aggressive asset allocation. Okay. Superior research is number 2. This is why the model works so well. First mover advantage. Network effect, number 4. 5, liquidity premium. And number 6, sophisticated investment staff and board oversight. And the big question is, why do large, because remember what we said over there, guys, that large endowments tend to outperform small endowments. Why is that so? Why do large endowment funds, the bigger guys, do better? Number 1, aggressive asset allocation. Okay, they're slightly more aggressive with their investments. Okay, and typically when you talk about being more aggressive, it means the allocation towards alternative assets. Okay, good. And if you have a look over here, what's interesting, okay, is that a massive amounts of sources of return for endowments come up to 93% over there, guys, comes from strategic asset allocation. What is strategic asset allocation? We spoke about this a little bit in chapter 11. Okay, and strategic asset allocation talks predominantly, okay, about the fact that you are long-term into an investment. You get in and you stick in there for the long term, and that's obviously a lot of what we talk about for alternative investments. Okay, so very important that we stick in for the long term, and that's where the majority of the source of return is coming from. Okay, where else can you get return from in terms of attribution of the return, albeit that it's relatively small relative to strategic, is tactical asset allocation. You move your assets around, okay, and security selection. In other words, you try and find a security, okay, that's not in the benchmark. Because if it's in the benchmark, that's part of strategic. And tactical, of course, is I try and move my asset weights around to try and take advantage of various opportunities within the market. But again, that's not giving you a whole batch of return. The most of the return comes from aggressive strategic allocation, sitting in alternative investments longer term, and that's where your return will come from. Okay, let's have a look. We move forward over here, guys. The next point is superior research. The large endowments get the better managers. Okay, remember, the better managers, and for the good or for the bad, the better managers typically go where the bigger endowments are, and the salaries and bonuses are typically higher. Okay, and they put a lot of time and research and effort into research. And remember what we said before in CAIA level 1, the more research that you are prepared to do, okay, the more likely you are to succeed in alternative investments, because that's where the alpha is, because no one else is looking there. When you look at traditional investments of equities and bonds, everybody's done all that research already. It's a bit of a saturated market. But if you want to make good money in the alternative space, put a lot of time into research. That's where you'll be successful. Third point for success of the large endowments is what we call first mover advantage. Okay, the guys that get in first are generally the more successful players. Okay, and remember, when you invest with an alternative asset manager and you're the first guy in and you've backed him, you've shown confidence in him, he's likely to stick with you over the long term over the new entrants to the market. Okay, and typically what we say in terms of first move advantage is the new investors into the market, okay, generally, okay, have returns that are below those of the initial investors. Of our page, network effect. What's that? The network effect, okay, is that, okay, when you are, the larger players are typically keeping the same kind of networks and alumni in their ranks. Okay, and what's very interesting, okay, there's a positive correlation between successful fund managers and the more prestigious universities. Okay, interesting topic for discussion, not to be had right now. Okay, but that's a very interesting discussion to have. Okay, number 5 is liquidity premium. Generally speaking, the large endowments have got longer time horizons. Remember what we said, the longer the time horizon, the more the time, the lower the liquidity requirements. Okay, and the lower the liquidity requirements and the higher the time, the greater the investment into alternative investments. Okay, they can sit in illiquid investments because they don't necessarily have liquidity requirements, and they've got a long time horizon as well. Okay, good. And the last point on top of page 6, guys, sophisticated investment staff and board oversight. Okay, generally the larger the endowments, they can invest in excellent internal staff. Okay, they make use of external consultants if need be as well. Okay, that's for the larger guys. The smaller guys can make use of what we call the outsourced CIO, Chief Investment Officer model. Okay, and that they make use of external guys, external consultants and advisors, and these external advisors generally have got quite a lot of power in terms of making decisions in terms of the investments of the endowment. Remember, of course, this model, the outsourced CIO or Chief Investment Officer model gives the small guys more flexibility and cost reductions as opposed to the bigger guys who have set up big teams. And of course, if you've got a big team, it's very expensive, but it's all internal and good resources that you've got. Okay. We move down a little bit over here, guys, to talk about demonstrate knowledge of the risks of the endowment model. Some of the things we're going to talk about specifically, we start off with spending rates. Okay, of course, there's a conflict between the spending rate, in other words, how much you spend, okay, on the one side. On the other side, capital preservation, because remember, guys, the more you spend, the less capital, of course, you're likely to have, and the higher your portfolio risk is likely to be. Okay, by way of example, the higher the current spending rate, the better it is for the current generation, okay, much more so than the future generation, okay, and the higher the current spending, the weaker the capital preservation, okay, and on the other side, the lower the risk, the lower the return, but then of course, greater chance of capital preservation because I'm not taking too many risks. Okay, a little bit of theory over here, don't spend too much time over there. Okay. I'm just going to give you a bit of an example over here over the page on the spending calculations, because what happened was initially there was fixed spending requirements in place. In other words, you had to spend a certain amount of your opening balance of your assets under management, okay, or your assets in the endowment for the coming year. What they then did is they said, well, that's a little bit harsh because sometimes times are more difficult, times are a little bit easier, different kinds of markets, different kinds of cycles. What they then did is they said, well, let's try and average that out a little bit. And they came up with this thing called the smoothing rate calculation, which I'm going to show you here. Okay, and what we top of page 7, we look at a rolling 3-year average spending rule. In other words, how much do I need to spend in time T? And guys, again, we're not going to be overly awed by formulas. It's of no interest to us. Of course, it's of interest to us, but we're not going to let it upset us at all. But spending in time period little t is dictated to us by what? The value of the assets beginning of the year, which is current period, less going back one period, the market value of my investments 2 periods back, and the market value of my investments 3-year period back, divide by 3. In other words, it's an average of these 3 time periods, assets, times by my spending rate, which in most cases is going to be approximately 5%. That's an average spending rule, as opposed to a fixed spending rule, which would say how much must I spend in time period T. Well, that'll equal to the market value now, or at the beginning of the year, T minus 1 times by the spending rate. Okay, as opposed to here, which is a bit of an average or a rolling spending rule. But remember, guys, generally speaking, I'm taking you back again, when do we look at spending rules? That's more for foundations. Foundations have got spending rules that are in place. Okay, endowments don't. Endowments, okay, generally it's much more flexible and they can spend as they wish. Okay, let's have a quick look at inflation. Okay, remember when I set my return targets, I do need to take into account inflation. Okay, in other words, because when I'm spending, I need to spend a certain amount. Okay, there is going to be inflation there, and based on that, I've got to earn a return that's well in excess of those particular spending plus inflationary amounts. Okay, we talk about over here, one of the ways for endowments to get real returns is to invest in real assets like real estate, natural resources. Remember, those are, remember from CAIA level 1, those are generally good inflationary hedges. Okay, other good investments are inflation-linked bonds, of course, because it takes into account inflation, commodities, and private equity investments. What's my key goal over here with real assets is to earn a long-term return that is comparable with equity, and short-term returns with comparable with fixed income securities. Okay. Endowments would like low levels of correlation with traditional assets, as well as, of course, low levels of volatility if they could choose that. Okay. Liquidity. Okay, very important, of course, when you look at an endowment or foundation, okay, that you match your assets and your liabilities. Okay, because remember that talks about the liquidity, because you may well have these lovely long-term assets, but short-term liabilities that need to be paid now, but you've got long-term assets that are not liquid, that can't make those payments right now. Okay, good. So just be careful with that. Okay. We talk about this concept, a very fancy concept, okay, called a liquidity beta. Wow. Okay, what's a liquidity beta? That's the level of liquidity of the particular investment. And of course, guys, alternative investments which are not very liquid have got liquidity betas much greater than 1. Of course, they do, because they are not very liquid. A very, very liquid would have a very low level of liquidity beta. Okay, good. Something interesting, guys. Okay, in 2007 and 8, the financial crisis, it was a lot of these endowments, particularly things like Harvard and all of those universities, found themselves sitting with very long-term assets, very illiquid assets in terms of the alternative space. And when the market turned against them in 2007 and 8, they were unable to make their payments as they were due. Okay, so it caused a lot of hassles at that particular time, and they were experiencing what we call a bit of a liquidity crunch. They were forced to borrow money or to postpone certain of their activities because they didn't have the sufficient liquidity available, because they were invested quite heavily in alternative and long-term assets. Okay, we talk about this lovely concept, guys, called LDI. Okay, and LDI talks about liquidity-driven investing. In other words, I match my investments to my liquidity. Okay, good. Okay, and you can just look at your various kind of assets. For example, tier 1 assets are low risk, high liquid assets. Tier 2 are high risk, more liquid. And tier 3 are things like alternatives, would fit into a tier 3 asset base, which are very risky and illiquid. Okay, generally speaking, would have a much larger allocation towards tier 1 and tier 2 assets, okay, to make sure my liquidities are taken care of for an endowment, and then I could put some of the balance towards tier 3 allocation, which is high risk and low levels of liquidity. Okay. Top of page 8, we talk about the various levels of liquidity within an endowment fund. Okay, and what we look at, generally speaking, is we say, well, what's the potential requirements or capital requirements from my investment commitments? Generally speaking, who would I have committed capital to? And you would have committed capital to two parties, generally to private equity players. Remember, if you are the limited partner, and you'd have also perhaps committed capital to for real estate investments. But remember, again, real estate investments, you don't put all the capital up front. They are generally developments, and they may take a little bit more time. Okay, good. And what we do is we put these two items, in other words, my total committed or potential capital calls, say for example it comes to $10 million, over the total size of the endowment fund. Let's say the endowment fund is 100 million in assets. Okay, the higher the percentage, the greater my liquidity requirement. Let's say, for example, over here, this is a fund that's got a 10% liquidity ratio, as opposed to, let's say, for example, another fund that has got commitments of 30 million with assets in my endowment of 100. They've got a 30% ratio. What would we conclude? We'd say that this one is, okay, has got greater liquidity requirements, okay, and the liquidity risk to the fund is, endowment fund is higher. Okay, good. Just watch out for this one. It's an important little ratio formula that's included over there. Okay, good. Okay. Some interesting facts over here, guys. Real estate funds, okay, call for capital faster than venture capital funds, generally. Okay, we will see this later on. I'm just going to mention it over here. Okay, an overcommitment strategy. What's an overcommitment strategy? An overcommitment strategy is when you overcommit. Okay, let's say, for example, you know you can only afford a certain amount in terms of investment in a private equity fund. Let's say, for example, the amount that you can afford is $10 million based on your current capital, but you go ahead and you commit to 20 million. knowing full well that you're going to be in trouble if they call for the full 20 million up front. But what? In most cases, they don't call for it up front. They call for it over many years in the future, by which point you've earned more money, or the fund itself has made payments out, which you can then use to fund that 20 million. That's called an overcommitment strategy. We'll talk about that a little bit more when we go there. It's quite an important strategy in terms of allocating assets, strategic asset allocation, but we'll talk about that a little bit more going forward. Okay, good. Okay. Just some points over here, guys. A little bit of history here. Don't spend too much time there. An endowment fund should allocate a certain amount of their portfolio to cash. Why should an endowment fund be keeping quite a bit of money? Not quite a bit, but a certain amount of money in cash. Let's see why. Number one, they can meet their capital requirements if need. Provide for emergencies. They may need to rebalance portfolios. If they need to spend more, they can provide for the higher spending rates. And of course, everybody likes a little bit of a cushion. Okay, if you're holding too many or a certain amount of alternative investments, you do want a certain cushion there that you can look after yourself in the event of any kind of mishap. Okay, on the other side, okay, you don't want too high a cash allocation, because if you've got too much sitting in cash, we always have this concept, guys, a very important concept called cash drag. We don't want a high level of cash drag, because remember, cash doesn't earn a high return, and that brings down the overall performance of my portfolio. Okay, good. Some other examples, guys, for endowment funds to try and make sure that their liquidity issues are taken care of is you can stagger allocations to private equity funds. Don't put them all off. Don't commit to investing in private equity or real estate commitments all in one go, all in 1 year. Okay, do it over a period of time. Okay, and the last way, of course, that one could try and get further funding into to make sure your liquidity is sorted out, you can seek further gifts or donations, or even borrowings if need be, to supplement the current fund. But again, remember, those are not always available. Okay, it's not always available for future borrowings. Okay, good. Okay, we move ahead. Okay, top of page 9, is the model still, the endowment model still valid? Because remember, some of the, and I'm just going to start off with the negative side, not because we're negative at all, but just makes more sense. Why it even came into question is because there was a massive liquidity squeeze during the 2007 and 8 crisis that said, well, why are all of these endowments sitting in these illiquid, okay, alternative investments? So we said, well, we know why they stay there. They're there because they're getting a high level of return, but of course that provided a great liquidity issue for them. Okay, good. Some arguments for the model. Okay, yes, liquidity is a concern. No one's going to question that, but mitigate for that. Sort yourselves out, get your ship in order, and you're going to be fine. Okay, and remember, one of the arguments for the model is because where else other than things like alternative investments are you going to get this high level of required return to be able to match your spending requirements? So that's how we look at both different sides of the model. No real, of course, when we have these arguments, is the model still valid? Some say yes, some say no. You're not going to come out with a 100% conclusion. Okay, we talk about rebalancing of the portfolio. Now, rebalancing of the portfolio, okay, is when my allocations, okay, move out of where they should be. Okay, and the reason that they do that is because maybe the portfolio has gained, maybe the portfolio has lost. We don't know. Okay, but that will send my allocations moving around, drifting this way and drifting that way, and they may need to be rebalanced back towards what we call an optimal portfolio. Okay, what are some of the benefits of rebalancing? Okay, remember, higher risk assets earn higher returns. Okay, so, and if you just let the portfolio drift and do what it does in terms of market forces, these higher risk assets will present a larger portion of my portfolio as they keep growing. Okay, but that also will increase the risk of the portfolio. Therefore, it might be a good idea then to rebalance them back to their targets. Okay. If we just let the portfolio drift, risk exposures will also drift from the desired risk exposures. Okay. And if you don't rebalance, what's going to happen is you may be holding onto overpriced assets. Okay. Long term, that's not a good idea either. Because remember, if you've got these long-term assets, then of course, if you've got these assets and they have made good gains for you, it's a good time to get out before they become overpriced, and of course then they fall back down in value. Okay, two major costs involved with rebalancing. In other words, why don't I rebalance all day, every day? Because there's costs. Number one, of course, there's transaction costs, and transaction costs, of course, erode my investment return. Okay. So it needs to be a trade-off of how often we rebalance and the cost of rebalancing. And there's tax costs. The tax cost, of course, is that when you rebalance, what does the IRS see that as? He sees it as you've sold something and you've made a gain. Because generally, I'm rebalancing. Once my assets increase in value, I sell them. It looks like a nice gain to the portfolio. There's tax costs. Okay. We look at two different major kinds of rebalancing approaches. Number one is calendar rebalancing. Calendar rebalancing is that there's certain predetermined dates. Let's say, for example, at the end of every quarter, okay, I rebalance. So it's at a certain predetermined date. Some of the benefits of this is that it's a very disciplined type of approach. It works nicely in terms of you know when you're going to do it. Everything is prepared and planned for. It's cost effective. Okay. The downside is that what happens in between the periods when there's no rebalancing done until you arrive at the next particular date. Okay, your portfolio weights may be quite out of kilter from what the strategic asset allocation says that they perhaps should be. Okay, good. Of our page, we look at top of page 10. Okay. Percentage, the PPR balance, the percentage range rebalancing, and the percentage range rebalancing says, okay, the minute I work within a corridor or a tolerance band as follows. Okay, and what we look at is, let's say, for example, okay, here's my equities, and my equities can be within 20 to 30%. When they're within this band, I don't rebalance. If they move below 20 or above 30, then yes, I will rebalance. Okay, good. There's a whole technique to it. There's a whole calculation behind it. I'm not going to spend too much time on that. Okay, but of course, just to know the concept behind it. We will see this again, by the way. Okay, still more stuff coming on rebalancing. Have no fear. Okay, good. Not going to spend too much more time over there. I do want to just have a quick look at learning objective 12.6 in terms of some kind of rebalancing over here when we talk about tactical asset allocation. And remember, guys, we spoke about this in chapter 11. Tactical asset allocation is short-term asset allocation, which makes short-term adjustments to my specific asset weightings based on short-term opportunities and what we predict that the market will do. Okay. Very often, guys, TAA is looked at as a contrarian approach to investing because strategic asset allocation often sticks with the weightings of that of the market. Tactical comes along and moves yourselves or moves away from those weights, okay, to try and achieve better returns, often referred to as a contrarian approach. Okay. And remember, TAA is a little bit more aggressive. Okay, can be used for various alternative investments, things like managed futures, okay, macro hedge funds, etc. Positions can be short, they can be long, they can be leveraged, and you can see, guys, there's a lot of various strategies that we could use just to make sure that we are earning a superior return. But remember, two things I just want to mention about tactical asset allocation. Number one is we don't move too far away from our strategic allocations. Okay, it's not as if I'm going to go and take my entire portfolio invested in this short-term opportunity. They are small little allocations that I make, number one, and number two, they are short-term, small amounts, and generally a short-term position take. Okay. We look at the last little bit over here, 12.7, tail risk, knowledge of tail risk, but you probably thought that you were doing an FRM when you read this, okay? But have no fear, guys, because if you think this is the last time you'll be seeing risk, okay, you need to look no further than topic 4, which is entitled Risk and Risk Management, which is very much risk-based. Okay, and the very first chapter over there, which is chapter 16, talks about cases in tail risk. Okay, so tail risk is going to be a nice one. Okay, when you look at tail risk, guys, okay, tail risk is in the tail, but which tail is it? It's, of course, it's the left tail. If I had to draw you a little picture over here, guys, for the normal distribution, okay, there would be your mean in the middle, and where's my risk? My risk is not here, not in that tail. These are both tails, by the way. This is the right tail, okay, and that's the left tail. The right tail I don't mind. The right tail is these massive, massive positive events. For example, a thing like when a medical company discovers a vaccine, and profits are shot out the window. Okay, that's a right tail event. But those are good ones. Left tail event is in the left tail, or a negative tail. Okay, it's unexpected and it causes massive, massive loss and damage. Things like a market crisis, an earthquake, or something like that. Okay, what we say about this one is that the endowment must be careful not to have too much tail risk that's associated or attached to them. Okay, how would you avoid that? Number one is you could completely avoid any investments with tail risk. How would you do that? Well, of course, then you just invest in US Treasuries, anything that is considered to be a risk-free investment. But remember, if it's risk-free, it's low return. Okay, that's the downside of such a strategy. Okay, at top of page 11, other ways that you can avoid this particularly is, okay, you can look at the portfolio's equity exposure and then just try and hedge against that particular exposure. And how would we hedge? We're going to see a lot more of hedging and risk management, of course, guys, in topic 4. But you can use things like equity options. We saw this in CAIA level 1. We'll see this again in topic 4. Okay, remember, if you have got a long position, a long asset position. Okay, in other words, let's say, for example, you own, excuse the picture, I think that's how they draw it. You own stock in Apple Incorporated. Okay, so you are a long-term holder. Remember what we always say, guys, long means, okay, you hold the investment, you are a long-term holder in Apple Corporation. And the current price, let's say, for example, of Apple Corporation is $120. Okay, I think that's more or less right. An over $2 trillion market cap. Wow. Okay. But what are you worried about? You're worried about tail risk. What's tail risk? Tail risk is that something could come into the market, and let's say, for example, China decides to cancel all purchase of Apple product. That 120 will drop precipitously. That would be called a tail event. How would you protect yourself against that? Using derivatives, okay, you would go long or buy, same thing, a put option. A put option on what? On Apple Corporation. Okay. Always remember, guys, you're here hopefully for my investment knowledge and not for my artwork, so please excuse the apples. Okay. And you would buy yourself a put option, let's say, for example, with an exercise price of 120. What does that mean? That means that the minute Apple Corporation drops below that price, you have a put option. You've got the option to, what to put means to sell your stock at 120. So if it does go below 120, you are protected because you can still sell it via your derivative instrument at $120. So if it goes down, say, to $50 with a massive tail event, you don't have to sell your stock at $50, which is the current market price. You can sell it at the exercise price, which you have negotiated up front via your derivative contract. Okay, good. So why doesn't everybody do this to protect themselves? Because remember, when you buy a put option, okay, it is quite expensive. Okay, why? Because you pay a option premium. Okay, so that's one of the reasons, of course, that put options are used, but not so much because they could be quite expensive. But yes, they are very good protectors against or mitigators of tail risk. Okay. Another way you can protect, guys, is you can use, in order to reduce the cost, is you can enter into what we call a collar. A collar is you buy an option and you sell an option. When you buy an option, you pay an option premium, and when you sell an option, you receive an option premium, so it offsets the cost a little bit. But as you can see, guys, from the word collar, and you remember this very well from the intro section of topic 2, okay, in CAIA level 1, okay, that will put a collar around the amount of gains and losses that you can possibly make, as opposed to a flat out strategy like buying a put option. Is there's no collar, there's no limits on the amount that you can protect yourself against. Okay, what seems to come up, guys, I'm just interested in it as I go through the CAIA syllabus, is that they like this strategy called a bear put spread. Okay, and remember, guys, okay, from CAIA level 1, you've seen this all before. Okay, and I've given you a bit of an example over here in the edge notes, so do have a look at that as well for your strategy. Okay, and a bear put spread is exactly, look at the words bear. In other words, you're thinking the market is going to go down. Put, I use put options, and a spread it is. For example, a spread is I'm long one and I am short, or I sell the other. That's always a spread, as opposed to an outright transaction where I just go either long or I go short. A spread, I take into account both a long and a short. Okay, so look over here. For example, the current price of the stock is 1,000. Okay, you could buy a put option at 900. What does that mean? That means if the stock drops from 1,000 down to 900, you are protected. Okay, you don't get any protection from the drop from 1,000 down to 900, because your exercise price is what? 900. So the first $100 is your own loss. From 900 you are protected. But then if it's a put spread, you sell a put option at 700, that means that you are protected from 900 only to the extent of 700. Thereafter you are unprotected again. Okay, I've given you an example of it over there. And again, why would you do a spread? Why wouldn't you just go for this particular transaction, the 900? Then you've got protection all the way from 900 down to 0, which is much more protection than it being protected just from 900 to 700, which is what we call the bull spread, because here you sold the put option to somebody else, so they get the protection from that point onwards. Because just by buying that one, it becomes expensive. So how do you offset your costs? You sell a put option as well. Okay, that lowers your costs. And the last two little points over here, ways to protect against tail risk, is you can look at correlations. It's quite a difficult one. Is you can say to yourself, you want to be invested in certain things that have got negative correlations with each other. So for example, when the market falls, you want to have assets that rise in such a market. That will protect you against tail risk. You don't want to be in an asset that as the market falls, the asset falls as well. In other words, they've got positive correlations with each other. You want assets with negative correlations. In other words, they work in other opposite directions. Okay, and the last approach to managing tail risk, okay, is how you allocate your assets within each class. Okay, for example, better to mitigate tail risk when you're looking at fixed income securities, which is an asset class, rather go for higher quality bonds than corporate bonds, which are lower quality. So yes, you are investing in fixed income securities, that is your asset class, but you've invested in the more secure side of that particular asset class. Okay, guys, that brings us to the end of Chapter 12, Foundations and the Endowment Model. As per usual, I've given you some checkers there. Please check and make sure that you are able to answer some of those questions. Okay, there we go. Just a couple, just to make sure you are on board. There are those. So some solutions there for you, of course. And then, obviously, because from Chapter 12, okay, all the way through to Chapter 15, guys, are previous CAIA, they were in the syllabus for CAIA Level 2 in the past. So we do have some nice past exam questions from those particular chapters. So you'll find for the next 3 after chapter 12, 13, 14 and 15, I've given you the questions that are that were asked in the CAIA practice papers. There they are. You have a look at those. Some nice questions as well, just to give you a little bit of exam practice. And of course, guys, please go ahead and do some of the CAIA questions from the CAIA workbook, which I have cut and pasted for you onto your papers. Please do those as well. They are very good exam practice. This brings us, of course, to the end of chapter 12, foundations and endowments. We have 3 more institutional asset owners to go. Chapter 13, pension fund, 14, sovereign wealth funds, and 15, family offices and the family office model.